Hey everybody, welcome back to the channel. My name is Justin. In this video, we're going to take a look at my portfolio and see how well it performed against the S&P 500 for the first 3 months of 2023. In fact, my portfolio is up about 23% versus S&P 500, which is up about 8% through March. So we're going to take a look at the stocks I sold during the first quarter, and then we're going to take a look at each stock I currently own in the portfolio and kind of see the performance so far since I've owned it. So kind of a gain and loss on each stock so far since I've really bought the stock inception to date. Now, if this is the first video watched of mine, again, my name is Justin. I am a value investor. You can see a lot of the books behind me from Howard Marks, Warren Buffett, Phil Town, Monish Pabrai, Ray Dalio. So I try to find stocks that are selling at a margin of safety, a discount to the market overall, understand the company, the industry, look at the management group, look at the financials and all that fun stuff there, and hopefully find a stock that is of really great value and one that I understand and I add it to my portfolio. So that's kind of my strategy in a nutshell there. If you're wondering how to value a stock, I do offer that on my Patreon. If you're interested, I'll put a link down below in the description if you're interested. So let's just take a look at the portfolio and just kind of go from there. All right, so let's take a look at how my portfolio performed each month through the first quarter. So you can see in January, I was up about 26%. February, I was down 2%. March, I was down 1%. Here's the corresponding S&P 500 each of the months. So obviously the first month I did very, very well. There was quite a few of the stocks that were up in my portfolio, and some of those actually sold, which we'll talk about here in a second. So year to date through the first quarter, I was up about 23%. S&P 500 is up 8%. That is a very, very small segment of time. So I'm a long-term investor. So really I'm looking at 5, 7, 10 years. That kind of gives you a good picture of how investors do, compared to the market. So again, this is a very short time frame, but that's kind of where I'm at year to date. Now, if we take a look at my portfolio, let's first talk about the stocks that I sold during the first quarter. Home builder stocks. So I had about 5 different home builder stocks from Toll Brothers, Polt Group. I ended up selling all of those. In fact, they were up about 35 to 40% in a short time frame, about 2 to 3 months. So I felt that the runway for those really shrank since they went up so much. So I did sell those. Now, most of my money is in tax-free accounts, so I don't have to really worry about the tax consequences as if I was had my money in a brokerage account or there was tax implications there overall. I did sell Netflix. I was up about 50% on that stock over a 6-month period. I did sell Adobe. That one was only up about 10%. I just found other places I wanted to put my money. 1-800-Flowers, interesting. So I actually bought this stock. I was talking about the stock well over a year ago. I think my average cost basis is around $20, $21, and that stock just tanked. When the market tanked last year, I ended up selling around $14, got back into it at $6. This is probably the only time I've ever timed it, and this is pure luck, where I bought it at the very low point. It was around $6 a share. It went up to around $10 or $11, and I sold. So I ended up actually having a gain in total for the stock from my loss originally and then my gain now. But it was not much. It might have been maybe 5% when I kind of factor in all those things. But I did sell that one. And then Tencent, that was my last Chinese stock that I had in my portfolio. I ended up selling that just because of the tensions between the United States and China right now. I just don't feel comfortable owning Chinese stocks because just that tension there. And I think it's going to continue to mount over time. So that's why I sold that. So now let's take a look at the stocks in my portfolio right now. And the first couple are Bank of America. That is a fairly new position of mine with the stock. Financial stocks just taking a beating over the last 3 weeks with a lot of the banking stocks on just selling because of the fear around regional banks in general and the Silicon Bank and that sort of thing out in California. So I own a very small percentage of that in my portfolio, less than 1%. So you can see my loss on that so far is 2%. But year to date, that stock is down 12%. So actually, it's recovered fairly well. And this, keep in mind, this is actually through April 14th, the year to date. So just keep that in mind. It's not through March. Generac Holdings, it's about 2% of my portfolio. I'm down 2% on that one. That's more of a cyclical type stock there. Carvana is definitely probably the highest risk stock that I have. I've been talking about that a lot on my channel. And I've been selling cover calls on the stock a lot over the last couple of months. In fact, I got my cost basis down almost by half, from about $50 all the way down to $27 a share. And at some point, I'll sell all my shares when those cover calls get called away at some point. Unfortunately, this has just been by far my worst stock that I've owned. In my portfolio being down 67%. Long term, I still think there's a chance it's going to be okay. But the company's in trouble. I mean, it has a lot of debt, doesn't have any cash flow. So there is a chance it could go bankrupt. It really, really could. But we'll just see how that plays out. Next couple of stocks. So Comcast, that's a pure value play. Actually, I think the stock is worth closer to $50 a share. I'm up 7% on that one right now. Fidelity National, that is a payment service provider. It's actually a pretty large company. It's $33 billion market cap. I'm down 7% on that one right now. Next up is Reservoir Media. I'm down about 5% on that one. I find this one just so fascinating. It's the only independent public music recorder and publisher. And I just find it fascinating with how the patents and intellectual property is formed around the music business in general. It's different than anything else you can think of, where, if a company has a drug they put on the market, usually they get like a 20-year patent on that. And after 20 years, then it could be copied. Well, music is very, very different. I mean, their copyrights last from anywhere from 70 years to 95 years. So just pretty unique overall. And that is a micro cap type stock. Next couple. So Citigroup, M&T Bank, those were two banks in my portfolio. M&T is a new one that I added actually this last quarter. Citigroup, I've talked a lot on this channel. I think it's very undervalued. I'm up 7% on that, down 1% on MTB, which I just bought. Stanley Black & Decker, I'm down 11%. That's one that owns a bunch of different types of tools from Stanley. You got Black & Decker, you have DeWalt, Troy-Bilt. It's actually been a very consistent company as far as operating income goes. Their operating margins historically around 11-12%. Now they've taken on extra debt over the last year, which I don't like, including in last month. But I do think the stock is undervalued as a whole on that one. Next couple, Charles Schwab is a new one of mine in my portfolio. It's a broker that I personally use. They actually come out with their earnings on Monday, including M&T Bank. So it'll be interesting to see how that plays out. Now, Charles Schwab, I think, as far as a risk standpoint, I think it's pretty low risk. But I do think this next quarter or two could have a lot of fluctuations to it. A lot of their interest income that they have, or interest revenue, is tied to deposits, money coming in and earning interest off those deposits for investments specifically. And that's almost half their revenue. And so I would imagine some of those have dropped. So we'll kind of see how that kind of plays out in the end. But the stock was down about 30%, so 38% year to date. I'm down about 13% on that one right now. Douglas Emmett, that is a REIT. I've talked about this a lot on my channel. I'm down 23% on this one. I think it's going to continue to have issues as long as the economy is lagging, interest rates are high. But I do think it's going to eventually recover long term. Baxter International, this one is just a turnaround play, in my personal opinion. They're trying to spin off parts of their business. They're a medical equipment manufacturer. So we'll kind of see how things play out. Now, keep in mind that I do have 22 positions in my portfolio right now, where the top 5 are about 40% of my portfolio. So my top positions are heavy compared to the rest. But I tend to invest in companies more that I feel that I have strong conviction on, but also have a higher margin of safety. So as we get higher up on some of these, because the ones I just showed you, around 4% of my portfolio each, they'll have kind of a higher percentage because they're higher conviction plays, in my personal opinion. All right, so let's go on and talk about the next couple. So iRobot is an arbitrage play for me. Amazon wants to buy them for about 1.7 billion. Right now, the market cap's 1.1 billion. So that could be a 50% uptick if that deal goes through. It may not go through. Right now, I'm at basically a push on that one. But we'll kind of see how that plays out. Google, I'm down about 7% on that one. It's a long-term play for me as well. Brookfield Asset Management Group, I'm up 1% on that one. That one actually went through really a massive change back in, I think, October. It was the fourth quarter of last year. So Brookfield, the parent company, actually broke off into different chunks, and one of those is the Brookfield Asset Management Group. And according to their investor presentation they did on it, they believe that the stock is going to get to or be worth $70 a share in a couple of years. So we'll kind of see how that plays out. But those are those. Next couple are, so we have Sitio Royalties. So we're kind of getting into some of the bigger positions in my portfolio. So this is a play on oil and gas. I didn't actually go into an operator like Exxon or Occidental, for example. I decided to go with a company that owns royalty rights to oil and gas. And so it's just kind of an oil and gas play on my behalf. And there's also a hedge against inflation. I'm up 15% on that one. The dividend's around 10%, but we'll kind of see how that plays out. Micron Technologies, I've talked about this one a ton on my channel. Memory chip producer. Now, recently, Samsung came out and said they're actually going to slow down their production of memory chips. So we'll kind of see how that impacts Micron and the industry long term. And I'm down about 9% on that one. I've owned that one for quite a while, I think 18 months or so at this point. Celanese, so this is a company, it's a knee-based company. They manufacture polymers, acetic acid. I'm up about 3% on that one right now. Let's talk about it. Next couple. So I have Wix.com, which is actually the second largest position in my portfolio. I'm up about 26% on that one. So this is a platform where you can go actually create your own website for your business. They're more kind of in tune with the small business owner. Shopify is obviously the biggest one in that space. They just put a ton of money back into the company over the last 2 years, which has hurt their free cash flow. But their free cash flow yield has a chance to get to 20 to 25% over the next couple of years. So I'm really, really liking that one as a long-term play. Meta Platforms, I'm up about 10% on that one right now. This one to me does carry risk. You just have no idea how much it's going to cost to get that metaverse going. If they can get up and running, but when they can, how much is that going to cost the company in the end? So I may end up looking to sell some of this as it goes up. We'll kind of see how that plays out. But that's about 6.5% of my portfolio. Then we have Warner Brothers Discovery. This is a company that was formed April of last year, where Discovery, Warner Media came together and merged. Warner Media came from AT&T. The downside of this one, a lot of debt on the books. In fact, it's they're a $33 billion market cap, and their debt's like $50 billion. So they are paying that down rapidly. But with the company combining, there's a potential or a hope from investors, including myself, that they're going to become more efficient. There's going to be a lot of synergies there. And I do think they can get to high single-digit operating margins in the next few years. And if they can do that, they should easily double what the stock is right now. But we'll see how that plays out. Now, the largest one in my portfolio is Ally Financial. It's about 10% of my portfolio in total. I'm about 10% down on that right now. Ally Financial is a bank. In fact, they spun off General Motors back in 2015. That was the finance business of the company that held all the car loans. And they still do a lot of car loans. About 60% of their portfolio is car loans, but it's been going down year over year. And they are the number one digital bank in the entire world. And it's interesting with this, the fallout of a lot of the regional banks here recently. I read a couple articles stating that Ally Financial had a high risk of going bankrupt. In fact, they listed the top 10 banks that were going to go bankrupt, and Ally Financial was one of those, which I kind of find humorous. Their deposits have grown tremendously. I mean, they have like well over $100 billion of deposits, about 3 million customers. So I think they're totally fine. I think it's a really well-run bank. It's a small bank at $8 billion compared to like Citigroup or Bank of America or Wells Fargo. But I think that bank is going to grow much faster than those larger banks long term. We'll just kind of see how that plays out. So that's my portfolio for the first quarter. I was up about 23% versus S&P 500, which was up about 8%. Hopefully that continues to play out that way for the rest of the year. Now, I did meet with some Morgan Stanley representatives yesterday, and interestingly enough, that they predict this year that the stock market's going to fall another 10 to 15% from where it's at right now, specifically at S&P 500. They think that the inflation, or at least the interest rates, will go up another 25 to 50 basis points over the next couple of months. But they do think a rally is going to happen in 2024, where the stock market's going to go up 20% in the first 6 months. So who knows? It's all projections. We'll see, if their crystal ball plays out or not. Nobody truly knows what's going to happen, but with inflation at historical highs, a lot of companies are hurting right now, especially smaller companies in general. So we'll just kind of see how that goes. But I'd be interesting to see, what are you guys buying right now? What are the best performing stocks in your portfolio? How is your portfolio doing right now, year to date? Love to hear from you. Thank you so much for watching. Again, if you would like to know how to value stocks, I do offer that on my Patreon. Again, I'll put a link down below if you want to go check that out. Thanks for watching. Take care, and God bless.